First of all, let's check if everyone can hear and see me. Please type plus in the chat section so that we could make sure that everyone can hear and see me and everything is working properly. Anyone? Pluses? I think we have. Okay, we have a few pluses, which means that everything is working. Very good. First of all, thank you for joining this webinar, which is going to be about recent stock changes that affect international structures of investors into Russia. And we will talk about new opportunities as well as challenges that international investors face in Russia. Before we will turn to the contents of the presentation. A few remarks on the administrative side. First of all, you will receive the recording of this event as well as the slides that we are going to translate. So after the events, everyone who is registered will receive materials. That's one thing. Second, please feel free to ask your questions. We have a questions tab in the menu, so you can check if you can see it. And please, as we go on, please ask your questions, and it will be most helpful for everyone if you ask questions if anything is not clear or you would like something more difficult and complex to be considered. And we will have a question and answer session after, in the last part of the webinar. So this is the plan. And by the way, we received a few questions before the webinar, which we are going to answer in the last section. Okay. So I think that this is it. The webinar will probably continue about 1 hour, maybe a little bit more, depending on the questions that we are going to receive. So this is the plan. This is the plan. Now, I think it's time to introduce myself. My name is Kalgin, and I'm a tax partner, and I work with corporate structures and help my clients to address challenges that they face when investing into Russia and paying taxes especially in cross-border situations. So this is my area of expertise, and we are going to talk about this during this webinar. And I will be joined by a colleague of mine, Goulis, and she will have a part in the first section of the webinar, and we will also address questions and provide answers together at the very end of the event. Okay, we'll have 4 parts in this webinar, and in this first part, where I will be joined by I will together with Nina address tax support measures that have recently become available to investors, and we will discuss what tax support measures can be used by taxpayers to improve the tax efficiency of their investments into Russia. And my part will address financial structures, and Nina will talk about other tax support measures. It will be important to discuss not only opportunities that are provided by the tax support measures, but also challenges. And although this is not specifically tax area, but it will be necessary to address restrictions and limitations that are now imposed on various transactions and cross-border situations and deals in Russia. And I will provide an update on the key restrictions that apply to cross-border transactions and situations. That will be the second part. In the third part, we will address a few practical cases. I will have 3 practical examples that I worked with my clients, and that will be the third section. And finally, we will answer the questions, both those that we received before the event and those that will come up during the event. I'd like to repeat that you are more than encouraged to ask your questions, and we have a special tab for this in the webinar interface. Okay, so let's move on and turn to the first section, which is tax support measures. And my part here will be about the support measures that address and that are applicable to various financing structures. And I will I'll address basically 4 main support measures that affect financial structures. One will be the possibility to write off debts without having to pay tax on income which arises due to debt write-off. Second will be a discussion about increased interest rate ranges. Then the third is taxation of foreign exchange differences that are now allowed to be taxable based on cash method rather than based on accrual basis. And finally, we'll discuss how foreign exchange rates are going to be used for Russian capitalization purposes. So all these 4 measures, they are relevant to financial structures. And let's consider the first one, where we have a foreign company that provided loan to a Russian company, and due to difficult financial situation, a decision was taken to support the Russian company, and the new incentive, the new tax support measure, allows this loan to be forgiven without tax implications for the Russian company. Because in normal circumstances, if a Russian company writes off its debt, it's going to be taxable income. Well, it's going to be income as such, because write-off of debt is a category, is income, is an item of income, and this income should be included in normal circumstances, should be included into taxable income of the Russian borrower. But now, more than a couple of months ago, there was a new law that introduced an exemption for forgiveness or write-off of such debts, and there are basically 2 conditions that the Russian borrower, that the structure will need to fulfill to apply this exemption, to avoid taxation of income that arises due to writing off of the debt. The first condition is that this debt should be loan agreements, or debt should be assigned. Either the loan agreement should be concluded before the 1st of March this year, or this debt should be assigned to the non-Russian lender before this date. That's one thing, and the exemption, this support measure, only effective this year. So this income and the write-off of such debts should take place this year. So this is a temporary measure, which is supposed to address financial difficulties that Russian companies are facing in new circumstances, and this year is going to be effective. Next year, regular rules will, resume to be applicable. There are a couple of questions that usually arise in connection with this tax support measure, with this incentive. First one, whether the exemption covers both loan principal and unpaid and accumulated interest. And recently, a clarification was issued, and the Federal Tax Service explained that, the answer is positive. Any accumulated interest that was not paid and is being part of this debt can also be written off free of taxation. So this answer is positive. And in the same letter, the Federal Tax Service also confirmed that there should be no withholding tax in connection with writing off of this debt and accumulated interest. So this is also good news. One question remains, and it still remains unanswered by the Federal Tax Service, whether interest which was actually paid and included into expense of the Russian borrower, whether this interest should be restored and included back to taxable base, because in other circumstances it is not uncommon for the Russian tax authorities to challenge interest expense which is related to debt which was not ultimately paid, for example, written off. This question remains unanswered, and unfortunately the risk exists that when debt is written off, any interest that was associated with this debt and included into expense of the Russian borrower will either be restored or have to become taxable when the write-off takes place. Although I think the professional community expresses some cautious optimism in relation to this matter, and I think there are grounds to say that interest expense related to the written off debts should not be included into income, but unfortunately, there is no certainty. There are no clarifications that confirm it, and some level of risk will definitely remain in connection with interest expense related to the debt that was written off. Okay, so that was the first item related to financial structure. The second is increased interest rate ranges. And again, let's look at the structure where there is a Russian borrower and there is a lender, which is a non-Russian company. We have loan, as shown on this picture. And as probably you know, there are limits within which interest expense can be deducted by Russian borrower. So basically, there are interest caps both on minimal interest and maximum interest that's applied to loans in Russia, to interest on loans in Russia. And obviously, when this is interest expense, the maximum debt is limited. Your maximum interest is limited. And the standard approach was it will first of all depends on the currency of the loan. If we have loan in Russian rubles, then the maximum deductible rate, the cap on interest deductibility, is linked to Russian central bank's key rate, and it is basically multiplied. The key rate is multiplied by 1.25. It's increased by 25%, and this is going to be the maximum rate. The key rate is subject to change, but interest on loans denominated in Russian rubles will be limited. Deductibility of this interest will be limited to the rate which is dependent on the central bank's key rate. This is, well, the increase of the central bank's key rates by 25% is the standard approach, but the temporary measures increase the maximum deductible rates to 1.8 of the central bank's key rates, which is, well, almost double the central bank's key rate for deductibility purposes. So this is definitely good news. In relation to interest that is related to debt in foreign currency, unfortunately, there is no change, and still the deductibility of such interest is limited by a formula which uses so-called, well, which uses a reference rate, which used to be LIBOR or Euribor, which is now obsolete, and there are other reference rates used for different currencies. But the point is that this reference rate is increased by 7 percentage points, and only, well, and this is the maximum rate that can be deducted. And unfortunately, there is no change in this respect, but still, I think this is quite generous, deductibility limit. And by the way, in controlled transactions in loans between related parties, it is also possible to prove that high rates is arm's length, is considered market rates, and that's subject to this confirmation. It is possible to deduct loan interest at a high rate, but the standard approach without further additional proof is as shown on the slides. And changes also affect the minimum rates, but this minimum rate is relevant in situations where there is a Russian lender which receives interest on loans. And the standard approach is that, again, the interest income shouldn't be too low. The minimum rates for loans in Russian rubles is, again, linked to central bank's key rates, and it can be lower than the central bank's key rate by 25%. That's the standard approach, but for the periods, this year and next year, it will be possible to use zero interest rate for such loans, which is, again, good news. And the same applies to loans denominated in foreign currencies, where it is also possible to use interest-free or zero rates for interest income, which provides some possibilities which we'll discuss in the third section, where we will consider practical examples. Okay, so this is the second measure. We will have a couple of more measures relating to financial structures. Then I'll pass the floor to Nina. So the third measure relates to taxation of foreign exchange differences. And if we consider the situation as is shown on the slides, where there is a foreign company that lends money to the Russian borrower, and if it is in, let's say, if the loan is denominated in euros, in non-Russian currency, then obviously, depending on the foreign exchange rate fluctuations, there will be positive or negative. So there will be gains or losses on the foreign exchange rates. And for example, if euro strengthens, then obviously the Russian company receives foreign exchange loss, and loss is usually, in normal circumstances, is deductible on accrual basis, and this is going to be the case this year. But starting next year, and well, the year after, in 2023 and 2024, it's the rule is that this interest, this foreign exchange loss, is going to be deductible only when interest is paid or otherwise settled, or no, not necessarily interest, but the debt itself. So there is a transition to cash basis for negative foreign exchange differences starting next year. And in relation to positive foreign exchange differences, the change already affects this year. And I think in most situations it's good news, because obviously income is taxable. And if euro weakens, which, by the way, has been the case, and over the last, let's say, month, we saw ruble strengthening against other major, against major currencies such as dollars and euros. And this gain relating to strengthening ruble is only going to be subject to tax and included into taxable income when this debt is settled, which is, I think, in most situations good news, because we kind of postpone taxation of foreign exchange, positive foreign exchange results, gains on foreign exchange, until the debt is settled. We do not have to include them into income immediately as they accrue, which is the normal kind of usual approach in Russia. Okay, so this measure should help clients or companies that borrow money in foreign currencies, or also have other types of debt in foreign currencies, against strengthening ruble, which we saw over the last month, or maybe even more. Okay, and the final one is fixed foreign exchange rates for thin consolidation purposes. Obviously, there are thin consolidation rules in Russia that affect structures where, as on this slide, a related party provided loan to a Russian borrower. And yeah, there are certain rules that limit deductibility of interest. And in a nutshell, these rules say that as long as debt does not exceed by more than 3 times the company's net assets, the company's essentially the borrower's equity, then interest related to this debt is deductible. But when debt exceeds this ratio, 3-to-1 ratio to equity, then the excess interest cannot be deducted, and moreover, this interest is requalified into dividends and subject to withholding tax. And obviously, this first of all, the volume, the amounts of debt, and the net assets, they are dependent on foreign exchange. They are subject to changes depending on foreign exchange rate, and to avoid implications where Russian borrower have to recharacterize more and more interest into dividends based on thin consolidation rules. It is supposed to fix these foreign exchange rates both for the calculation of the amounts of debt and for calculation of the Russian borrower's net assets. And the interest is fixed as of 1st of February this year. And this transitional measure applies this year and next year, which is also good news for any Russian subsidiary of a multinational which is being financed in non-Russian currency and therefore subject to foreign exchange rates fluctuation. Okay, these 4 measures, they address financial structures, but there are other tax incentives and tax support measures which my colleague Nina Goulis will address, and in a few seconds she will be here, and I'll pass the floor to her to explain and address further tax support measures. So please stay online. Nina will be here in a few seconds.
Dear colleagues, hello. I'm very glad to see you all online. Thank you for finding time to join us today. My name is Nina Goulis. I'm a corporate tax partner. And a part of being a KPMG partner, I'm also a chairman of the Taxation Committee of Association of European Businesses here in Moscow. And for the last couple of months, we all had a very busy time here to speak to our clients, to understand the level of support they need to maintain their activities and simply to survive during the economic turbulence. And the part of measures that Victor already mentioned, there are a couple of things, there are a couple of measures that are also very important and was very well received by companies operating in Russia. So first of all, recently, Russian government introduced deferral of social charges. For some companies, social charges here in Russia is a nightmare in terms of the level of charges. So for some of them, the level of charges is up to 30% of the salary, and deferral of this charge is very important and very supportive during this time. So payments of these charges for Q2 2002 and Q3 2002 is delayed for up to 12 months for certain industries. I should say that first of all, the coverage of industries is quite substantial. And for Q2 2002, the coverage is almost 70 industries, 70 types of activities that can obtain this deferral. But you must be very attentive. You must pay very great attention to details, because the list of industries covered for Q3 2022 is not the same and differs from the list for Q2. To be precise, for Q3 2022, the list covers 30 industries. Just to remind you, for Q2, the list covers 70. So please pay attention to details and check once again if you are a qualified industry for Q2 and separately for Q3 2022. The next thing, late payment penalties. So here in Russia, if you do not pay taxes on time, then starting from the next day of a delay, you should charge penalty, or tax authorities will charge you late payment penalties. And they are calculated with the use of the key rate published by the Central Bank of Russia. And starting from the late February, the key rate jumped up significantly from 8.5% to 20%, and it really became a nightmare for companies, because the level of penalties, the size of penalties jumped almost 2 or 3 times, because there is a certain rule in Russian tax legislation that says that starting from the 31st day of the delay, the twofold rate penalty should be calculated. But due to the changes, due to the support measures introduced recently, for the period from the 9th March 2022 to the end, until the end of December 2023, the twofold rate penalty is abolished. So you calculate penalty interest in a normal way. And by the way, today we received good news. The key rate of the central bank has been reduced significantly until 11%. Just to remind you, it was 8.5 in February. In late February, it became 20. In 2 months, it became 14. And starting from tomorrow, it will be 11. So for the calculation of late penalty interest and for the calculation of intervals for interest, this is good news. Sometimes good, sometimes bad for interest, but basically business reacted positively with this news that the key rate so dramatically reduced. The next good thing relate to VAT. As it was recently introduced, there is a significant speed up of VAT recovery process. Under the normal way, the VAT recovery or VAT refund could take several months. And within this special procedure, the VAT recovery takes several weeks. And VAT can be obtained or refunded by a taxpayer before desk tax audit is completed. And basically, this procedure is now available almost for all taxpayers and without any bank guarantee. This procedure before these amendments was available only for large taxpayers who paid a lot of taxes to Russian budget, and now it became available for almost all companies. There are certain criteria, you see them on the slide, but basically it is expected that under normal way of business, companies that operate in Russia, they will qualify for this criteria and can obtain this VAT refund in a way that will allow them to get this refund in several weeks after they submit the declaration. Corporate income tax. Victor covered almost all things. Just to remind you that there are intervals for the calculation of interest rates, which correspond to those that have been introduced during the COVID times and even before. And also there are amendments to foreign exchange rate differences calculations. I should say that these changes in terms of forex calculation are still under great discussion in business community, because there are pros and cons in terms of this provision, but we are where we are, and companies calculate these forex differences in accordance with the new rules. Corporate property tax and corporate land tax, there are also amendments. So basically, for the purposes of calculation of these taxes for 2023, for those taxpayers that calculate these taxes based on the cadastral value of real estate, this cadastral value is frozen at the level determined as at 1st January 2022. So this is good news because basically your tax obligation should be the same in 2023, the same as for 2022. The last but not the least thing related to taxes, personal income tax. There is a provision recently introduced into the tax legislation that relate to so-called material benefit. And it says that any kind of income received in the form of this material benefit is exempt from personal income tax, even for 2021, so for past period. And this exemption applies until 2023. So this means that for companies and for example, employees of these companies that have, for example, loans from these companies with the use of the reduced interest income can be exempt from personal income tax in respect of material benefit that should be calculated in respect of the difference in interest rates. There is also an amendment with regard to interest income, which is also exempt from personal income tax for deposits in Russian banks, and also for 2021 and for 2022. And the last general things, also good news, this relates to transfer pricing. For 2022, 2023, there will be no fines for the violation of TP rules. There is a question regarding the period of application of this rule. So it applies for income and expenses determined for these periods indicated on the slide. So it does not apply for income and expenses calculated for 2021. This is important to mention. There is also an amendment to transfer pricing legislation in terms of controlled transactions. So the threshold for these transactions is not 60 million. It's now for 2022 and 2023, 120 million. So it was doubled. These are not all amendments to legislation. These are the main amendments to legislation. And we also expect the second, let's say, the second draft law that should come in respect of amendments due to crisis. And therefore, we will inform you accordingly. Please follow our messages, our alerts to learn how tax legislation changes. I pass the word to Victor to say and to address challenges that currently faces our clients faces. Thank you very much. I will join Q&A session later. So if you have any questions, please address them and put them into the chat so we discuss them later. Thank you very much.
Hello again, and let me, before we move on, check everything. If everything is still in order, please type pluses in the chat section of the webinar so that we could make sure that you can see me and hear me. Do we have confirmations that everything works? certainly do hope so. Okay, yeah, we do. Yeah, as Nina said, unfortunately, although there are tax support measures and opportunities that are provided to multinational companies investing into Russia to improve their cross-border structures and the tax efficiency of their Russian operations, there are also challenges. And these challenges, they complicate, sometimes prevent many transactions that used to be normal before recently. And I will address three main restrictions on cross-border transactions that affect most cross-border structures that international investors have in Russia. And although this is not exactly a tax area, we do work with our legal team on these restrictions and limitations, and we all need to address and take them into account when structuring transactions and considering what we can do in this new environment. So the three restrictions that we are going to discuss are on the slides. One relates to limitation. Well, one relates basically to ban or restriction on disposal of certain assets. We'll talk about this. Second, limits distribution of dividends. And there are also certain limitations on loans that Russian companies can provide abroad, outside of Russia. Restrictions on disposal of assets. This is the first item. Let's look at the structure that is on the slides. We have a Russian subsidiary of a non-Russian company. It can have assets, and in this example, this is going to be immovable property. And the first restriction relates to transactions that involve so-called non-friendly countries. And unfortunately, this list that Russia introduced in March this year of so-called unfriendly countries is quite broad, and it includes all countries that are members to the European Union, as well as some other states. I think it's somewhere between 50, maybe 40 and 50 countries that are on this list. And if a party to a transaction is an entity, for example, a company, as on this slide, is located in this unfriendly country, then certain transactions are disallowed, they are restricted. And the rules say that transactions that lead to, well, quote, establishments of property rights in relation to shares and immovable property. Such transactions where an unfriendly an entity from a so-called unfriendly country is a party to such a transaction, then such transactions are not allowed. So once again, the restriction relates to immovable property as well as shares. And strictly speaking, it does not cover property rights in limited liability companies that are not considered shares, which gives room for transactions with such assets. And this is not always supported by, by those who help to carry out such transactions, because change of ownership in a Russian limited liability company, it is subject to state registration, and there should be authorization by a notary, and not all of them, are interpreting the rules formally, and they tend to interpret the rules more broadly. But strictly speaking, and some of those who are involved in these transactions, they support a formal and narrow limitation. So these rules only cover, the restrictions only cover immovable property and shares, for example, if we're talking about a Russian joint stock company. And not only entities that are located in these non-friendly countries, but also entities like Russian subsidiaries that are controlled by entities in these non-friendly countries are also subject to these limitations. And I have a practical case where a Russian company that sells real estate is unable to conclude transactions, to have deals with Russian citizens, simply on the mere basis that in the ownership chain there is a non-Russian company which is located in the European Union, and that is the basis for the authorities that are responsible for registration of transactions with immovable property, registration of rights to immovable property, to disallow such transactions, which is unfortunate, but this is, well, it is what it is. There are exemptions to this restriction, to this rule, and they require that the parties to the transactions are controlled by Russian entities, and this control should be disclosed with the Russian tax authorities. Strictly speaking, it is not likely that in structures of international companies we will see, Russian residents that control the group, that control the structure, and it is not likely that in structures that multinational companies have in Russia, this exemption would apply, but it wouldn't be fair to not to mention this. So again, there are exceptions to the rule, to the restriction, but they are mostly related to structures where there are Russian shareholders rather than international investors and multinational companies that control Russian operations. Second restriction is well, complete ban on distribution of dividends in certain circumstances, or I should probably say limitation of distribution of dividends, but because they are not completely banned currently, but they are significantly limited. If we have a structure where a Russian company is trying to distribute dividends to its non-Russian parent entity, then if the parent entity is located in a so-called non-friendly country, then for Russian joint stock companies, the distribution of dividends is only limited to 10 million rubles, which is about $170,000 per month. And in excess of that amount, the distribution of dividends is not allowed. Interestingly enough, this limitation does not formally address distribution of dividends by Russian limited liability companies, but again, sometimes banks that are carrying out, that are responsible for payments, they tend to interpret the rule broadly and also complicate or completely disallow distribution of dividends by limited liability companies. But despite, again, formally rules do not limit such distributions. But, well, okay, it is, again, what it is. And I think this is the common situation that with most limitations, that, first of all, they are drafted not very precisely and rather vaguely. And second, that those who involved into interpretation of these rules, they tend to interpret these rules broadly, just out of, just to stay on the safe side. And in situations where dividends cannot be distributed, it will be logical to consider lending funds instead of distribution of dividends, just to find a way to pay money from Russia to a non-Russian entity of the group. And unfortunately, loans in most cases are also disallowed. And if the borrower is located in a non-friendly country, then loans are completely disallowed. And in any currency, and in foreign currency, it doesn't really matter where the borrower is located. Whether it is friendly country or non-friendly country, then in any case, such loans are not allowed, which obviously complicates cross-border transactions and any attempts to pay money cash from Russia to outside Russia, to abroad, to foreign companies of the group. What to do? And it's really hard to tell, but there are formal methods, and most rules, most restrictions, they allow to obtain certain approval. It depends on a particular restriction, who is the body responsible for granting such an approval. For example, for transactions with assets, the government or its commission, the government's commission, can provide exemption or approval on transaction which is restricted with, as I mentioned, with shares and immovable property. For loans as far as I remember, it is the central bank that can allow the transaction, and the same applies to distribution of dividends. Unfortunately, well, at least my experience of my clients tends to demonstrate that practically it is difficult to obtain an approval, and I have a number of cases where approval was requested but hasn't been granted, and it continues on, and unfortunately there is no limitation, there is no specific period during which the approval should be granted, and this creates, the uncertainty as to when and how this approval will be obtained. And second thing is, again, I mentioned that there are participants to transactions, providers or notaries, or who are involved in execution of transactions, and they tend to interpret the rules differently. And in certain situations, it is possible to go to a provider which is, let's say, a bit less conservative in interpreting the rules, and this will allow to execute the transaction, for example, with shares in or with participation interest in limited liability companies. This is it on the restrictions and limitations, and we now move on to practical cases where I'm going to consider 3 examples from, again, my practical experience that kind of demonstrate how these restrictions as well as tax support measures can be applied in practice. So the first example, in the very beginning, I mentioned that it is possible to write off a loan, and if it happens this year, then the temporary measures allow not to include interest on loan write-off into taxable income of the Russian borrower. But in some cases, it makes sense to consider other ways to support Russian subsidiary, which is the borrower of the loan, and there are ways to convert this loan into equity, and it at least can be considered as an alternative to writing off of loan. For example, because this conversion can be made in a way that it increases the cost basis in the Russian subsidiary, so that when the parent company disposes of this subsidiary, then it is possible to deduct the acquisition cost, which includes the converted loan, against taxable income of the parent company. It is also possible to execute the conversion in a way that mitigates the risk that interest expense on the loan is not disallowed, because, again, as I mentioned, there is a risk then that when the loan is written off, that interest expense that relates to this loan will be included back into taxable income, or otherwise the tax authorities will require this expense to be restored and somehow become taxable. While in certain situations where conversion of loan into equity is made, it is possible to mitigate this risk. And obviously, in situations where loan is repaid and then out of this money contribution is made, this risk is even more manageable. Again, having said that, this repayment and cross-border transactions are now complicated. And for example, if it is difficult to convert this loan into shares, because issuance of shares to parent companies located in those non-friendly countries is prohibited, it is possible to use other legal mechanisms that essentially lead to the same result. It can be, this loan can be in one way or another contributed into, so-called, made as a contribution into property of the Russian company, which doesn't require issuance of new shares, doesn't involve new capital to be issued, but still provides the same economic result. Okay, so this is the first example which demonstrates that there are other ways to support the Russian subsidiary apart from newly introduced tax-free write-off of debt, for example, conversion of this debt into equity. Okay, second example, and it is not uncommon these days that non-Russian companies, that multinational companies, they leave Russia, and one of the ways for them to dispose of their Russian assets is to sell these assets to the management of the Russian subsidiary. And in many cases, this transaction is carried out at a, rather small consideration, because, it's not about generating profits or gains on the disposal of assets. It's more about leaving Russia and, excluding the Russian parts, the Russian subsidiary from the multinational company's structure. One option would be to sell the Russian subsidiary directly to Russian management. But again, if the parent company is located in the country, well, pretty much in most countries where multinational investors tend to locate their parent companies, if this transaction is disallowed because of the new restrictions, then another possibility would be to sell the shares in the parent company. If this parent company, its only asset is the Russian subsidiary, which is not uncommon, or if it is possible to extract all other assets from this parent company, and then its only asset becomes the Russian subsidiary, then a viable alternative to buying out of the Russian company would be to acquire, for the Russian management to acquire the shares in the parent company, which is outside of Russia, in which case limitations would not apply. And then question arises, if this parent company has significant assets, then acquisition for a value which is below the market value of this non-Russian company is going to be considered as a so-called material gain. It is qualified as an item of income for Russian tax resident individuals. But as Nina mentioned, and this is a new tax support measure, material gain for this year as well as next year is exempt from taxation, which allows carrying out these transactions, as on this slide, with shares in a non-Russian company at a value which is far below its market value, which is usually estimated, at least as some indication, it is usually used, its net assets the net assets of the company is usually considered as a good indication of its market value. And strictly speaking, when acquisition takes place and the consideration is lower than the net assets of the company, of the shares that are being acquired, then this difference is considered the material gain. So the good news here is that this still can be carried out without tax obligations, without tax burden for the Russian management that acquires the foreign company. Okay, and we will then, after the acquisition takes place, we have structure which is shown on this slide, and obviously it may not make sense for the Russian management to keep the non-Russian entity in the structure, and then question arises how this is going to be restructured, and we can consider, for example, liquidation of this non-Russian parent company, but in many cases it is more practical to acquire the Russian subsidiary and then use the exemption that relates to non-Russian companies controlled by Russian management. I mentioned it in the previous section, and now it's going to apply here, which allows this transaction to be carried out. So the acquisition of the Russian subsidiary may make sense in this structure, after which, and again, the acquisition can take place at a relatively low value, to avoid significant cash flows, and it just doesn't make a lot of sense to acquire in this structure, to acquire the Russian subsidiary for a significant consideration, in which case we'll end up with a simplified structure without the Russian parent, without the non-Russian parent company, which can then be liquidated. But again, here we'll need to think in this structure what is the best solution for removing the non-Russian layer, the non-Russian company from the structure. And finally, and again, this final third example goes back to the new increased limits on interest rates. And as I said in the beginning, this year and next year, it is possible to use 0% rates on loans that are extended from Russia, let's say, to a related company abroad. And formally, this does not this shouldn't lead to imputation of interest income, because zero rate loans are considered to be within the range which is used temporarily for the period from this to next year. However, and again, this zero interest rate applies both to loans in foreign currency and in rubles. However, it will be necessary to address various, consequences that relate to provision of loans based on zero interest rate. So, for example, if the Russian subsidiary has other borrowings, then the interest expense on these borrowings can be questioned by the tax authorities, because they can treat interest-free loans as an indication that the company didn't really need money and shouldn't deduct interest expense on its borrowings. And yeah, there are other things to consider. So, for example, it does require a certain risk tolerance, this use of interest-free loans, because, well, the tax authorities may try to requalify this loan into dividends. But still, I've seen in practice structures where loans were provided abroad, and again, if, well, circumstances allow and there is some risk tolerance, it is possible to consider using zero interest rate, or reducing interest rates either to zero or closer to zero, so that in this situation there is no excess interest income in Russia, and we still remain within the increased thresholds of increased interest rate limits that are provided for this and next years. Okay, I think this is the last example, and this finishes the third section. And I will be joined by Nina in the Q&A section. We will answer questions that we received before the webinar, and also those questions that we will have in the questions tab. Okay, so please stay online, and we will be back in a few seconds together with Nina. Hello again. Okay, should we check if everything is still working? I
hope so.
Okay.
That it is still working.
Yeah, and we there is 1 hour, exactly 1 hour after we started the events, and I think we'll take maybe 10 minutes to answer the questions, and we have a number of questions that we received before the events, and I will read the first one, and Nina will answer it.
Let us go first.
Yes. So the question is, do you have any recommendations how to pay VAT for IT to Russia without breaking any rules?
Well, it's a good question. I think it relates to VAT on electronic supply services, which was a question and a challenge for companies over the last couple of years. So the quick answer is that Russian company should pay this VAT transferred to the Russian budget, and there is a clarification letter issued by the Russian tax authorities in the late March this year with the confirmation of this approach. And in this letter, Federal Tax Service basically confirmed that under current circumstances, if a Russian company pays this VAT, transfers it to the budget, so there should not be any double taxation, and the obligation of a foreign company shall be fulfilled by such a transfer. So hope that I answer a question.
Yeah, I think fair enough. Okay, next question. Yeah. Will you read it?
Okay, quite a difficult question, I think. How do you assess the likelihood of revising the double tax treaty with so-called unfriendly countries?
Yeah, I think it's a common concern, although from what I saw in the public domain, it looks like only a couple of countries decided to cancel treaties with Russia. and I think this is one country was from the Baltic states. It was Latvia, and the second country is Ukraine. All the rest, they do not seem to intend immediately to cancel treaties with Russia, although a few countries, they announced that they are not going to exchange information, and this is going to be, I think, much more common approach that some countries will not provide tax information to Russia, and these countries include the United States, the United Kingdom, the countries of the Channel Islands, and I think a few more, but those are the main countries that announced that they are not going to cooperate with Russia in the tax area. But it looks like, well, what's going on is going to complicate any negotiations and discussions with between Russia and other countries. And we know that there were Russia intended to renegotiate the tax treaty with Switzerland and a few other countries. And a few months ago, news emerged that these negotiations were put on hold, and it's not really clear. But in a way, it's positive news, because Russia intended to increase withholding tax rates, while the current treaty with Switzerland, if it remains unchanged and it's not cancelled, will provide quite favorable withholding tax rates. So the short answer, it doesn't seem like a lot of countries are going to cancel treaties with Russia, but it will definitely, the current situation will definitely complicate the exchange of information, and maybe it will lead to some countries to cancel treaties, but it doesn't seem like a widespread trend so far. So hopefully treaties will remain, and obviously international investors will be able to benefit from reduced withholding tax rates and other treaty benefits.
Just to remind for those who are still with us that double tax treaty with the Netherlands, there is no double tax treaty, and there was a hope that there will be negotiations, but I think they are currently even not on hold, but not even started probably. Yeah, therefore one of the countries that was and had a good trade and other relations with Russia, so we still do not have this double tax treaty, and I think in the nearest future, negotiations.
It's unlikely that any negotiations will be resumed, and it's not likely that we'll see a treaty between Russia and the Netherlands anytime soon. But let's hope for better. You're right. There were rumors that in new treaty, the Netherlands actually had an idea, a proposal to conclude a new treaty, which was cancelled last year based on Russian. It was Russian initiative to cancel the treaty. But yeah, again, it is what it is. Hopefully, in the future we will have the treaty with the Netherlands, but it's not going to. We're not going to see negotiations happening anytime soon.
Okay.
Yeah.
Thank you.
Okay, next question. Due to the closure of the borders, suppliers cannot send the originals of the acts, so I think acts and as well as other supporting documents. Is it possible under the current conditions to confirm expenses with copies of documents?
Yeah, I think it's a question to me. Okay. Yeah. Well, this is a really big problem right now for Russia in terms of documents and documentation support that is required for Russian companies to support their expenses for tax purposes and for confirmation of withholding income tax rate, especially the reduced one, the rate that is applied based on the double tax treaty. And this is a problem. And we spoke with the Federal Tax Service on this matter, and got a reply that, of course, they understand the situation, and companies now submit scans of the documents, and the tax authorities accept these documents in a scan format, but with the obligation to submit originals as soon as possible when the situation permits. I didn't actually see the official letter or official approval of this approach. But the practical situation that we currently see is what I just described, because basically for some companies it is really impossible to get originals on time required by the current legislation. Therefore, if you have copies, talk to your tax inspection, show them these copies, try to submit these copies, and once you get originals, send them in line with other documents. So this is a kind of recommendation.
Mm-hmm, mm-hmm. And what do you think about electronic signature? Because I think, well, at least I consider it to be one of the solutions, and there are discussions what kind of signature is required, and obviously it needs to be set up. But what do you think?
Yes, this might be a solution, but it is not an easy way right now for this electronic signature, especially for multinationals, due to certain restrictions. This can be a way how it is settled, but if a company does not have or didn't have this solution in their current business activities, so it might be not a good time right now at present to implement it, because there are practical difficulties, as far as I know, for companies to implement. Once they solve these difficulties, yes, this can be a solution.
Yeah, because ultimately it will allow not to exchange originals at all if electronic signature is in place.
This is a great solution, for companies to exchange documents.
Yeah. Will you read the next question?
Yes, this is a long question for you. How to deal with withholding tax at source from almost any payments, in particular from payments for services providing remote access to online services in the CIS countries, when withholding tax at source from almost any payments is the position of the regulatory authorities of the CIS countries?
Yeah. Yeah, it's a fair question. I think it mostly relates to countries of, well, not really in Russia, but in countries like Uzbekistan, Kazakhstan, Azerbaijan. That's from my previous experience. I understand that they are not very well sophisticated. Tax authorities are not really sophisticated, and they sometimes just do not apply international tax treaties properly. And indeed, they tend to insist on withholding of tax from almost any payments, sometimes from payments which are subject to withholding tax based on domestic law, but should not be subject, like services in the question, based on the treaties between, well, the respective country and the country where the service recipient is located. It is really difficult to, there is no simple answer to this question. Solution is not that straightforward, but the idea is that the tax authorities need to be educated in a way, and taxpayers can, discuss what's international experience and what's international rules are, and encourage the tax authorities to follow them. And I'm aware of examples. For example, last year I had a discussion with our colleagues in Uzbekistan, and they supported a number of tax audits where the tax authorities insisted on withholding tax on royalties, while it was a situation where royalties were paid, I think, in islands from Uzbekistan, and there is a treaty between Uzbekistan and islands, and ultimately, well, at the end of the day, it was possible to persuade the tax authorities that such payments should not be subject to withholding tax, and the treaty should apply, and that the company, the licensor that received royalties, is able to benefit from the reduced withholding tax rates. So there is no simple, way, but the right way is to talk to the tax authorities and try to, and it's best to be, a collective endeavor. I would say, for example, Association of European Business does this on a regular basis, talk to the tax authorities and, explain the position of the taxpayers to them. And I think this is the only way. Discussion, education of the tax authorities, and finding a common grounds and solutions. which are applied in other countries, and international principles which work in, which are basically based on the tax treaties.
Okay, thank you.
Yep. Next question. In your opinion, does the new increased criterion, 120 million rubles, apply to the definition of controlled transactions for 2021?
Well, this is also a good question. It is not directly written into the tax code and into the amendments regarding the period of application of this new rule, let's say. Again, there is a letter recently issued by the Federal Tax Service. They answered this question, and they basically say that this new increased level applies to income and expenses formed for 2022.
This year.
This year, starting from this year. So when you calculate your income and expenses for the last year, 2021, you apply 60 million at the criteria.
Okay. Yeah, and I can really read the last one because
it's
the longest question.
Yes.
It's the longest question, but I think I read it in advance, and I think that the answer is really
you have
simple.
A privilege.
Yeah. Let me read it out. The amendments established that the dates of receipt of income in the form of a positive foreign exchange difference that arose in 2021-2024 is the date of termination or fulfillment of claims. Okay, this is the statement, and this is the right statement. At the same time, similar changes in Article 272, date of recognition of expenses in relation to negative exchange differences recognized in expenses will come into force only in relation to expenses incurred from the 1st of January 2023. And I think there is no explicit question here, but I think this is the express of doubts and surprise that there are different rules for positive and negative foreign exchange differences, and the negative foreign exchange differences, they only start to be deductible on cash basis next year, while positive foreign exchange differences, they already start to be taxable on a cash basis this year. And this is stated in the question, and this is the right interpretation. This is exactly what is written in the law, and one may be surprised by this, but in my view, it's fair, because positive gains, they are kind of deferred, their taxation is kind of deferred until the payment is made, while negative losses and expenses, they can be deducted earlier before the debt is settled, but still, there is a possibility.
Fair for companies.
Yes, it's a good outcome, good treatment, good approach for Russian lenders, for Russian subsidiaries of multinational companies which have foreign exchange differences. So okay, the statement is correct, and it was supposed to be different for foreign exchange gains and losses. Yeah, do we have? Let me ask a question. Do we have any more questions? That we didn't receive any additional questions, so I think that ends the Q&A session. And one final thing, we discussed tax support measures and opportunities to improve tax position of Russian companies, of multinational companies that conduct business in Russia. And what we propose is, for those who are interested to in discussions, in analysis, and maybe diagnostics of whether these new support measures apply in your particular situation, your particular structure, then we propose that we can talk to you on a free of charge basis, based on initial review of your situation. And if you're interested in such a discussion, please write us an email, and we will spend time to review your structure and explain, talk to you, and at least on a preliminary basis, see to what extent you can benefit from the tax measures that were introduced recently. So this is what we propose, and you will see our contact details on the next slide. And I think that this finishes our presentation, and it was a pleasure to be with you for more than an hour, and let's keep in touch and see you on our next events.
Yeah, thank you very much. See you next time. Bye-bye.
Yep. Thank you.